Hello, in this session we would look at the balance sheet. The balance sheet is one of the major financial statements along the income statement as well as the statement of cash flow. So if you are an accounting student or a CPA candidate, you will need to know everything about the balance sheet. Now, if you're specifically a CPA candidate and you're studying for your CPA, I don't replace your course. I don't replace your Wiley, your Gleim, your Becker, or your Roger. What I do is I am an addition. I can be a supplemental tool, because when I'm going to go over the balance sheet today, I'm going to cover the balance sheet from A to Z. So I'm going to cover everything about the balance sheet in details, and a little bit more in details than a typical CPA course will go over. Now, what I suggest you do, if you need additional help about this topic, as well as other topics, please check out my website. If not for anything, check out how well your university is doing on the CPA exam. You can check your score by college, by section. You can check the average score and the average score per section. I also have additional courses on my website: financial accounting, managerial accounting, intermediate accounting, so on and so forth. Please connect with me on LinkedIn and like my YouTube and subscribe to the channel, because I constantly update my videos. So this way I don't want you to miss anything, and connect with me on Instagram and Facebook as well. The balance sheet, sometimes referred to as the statements of financial position. Okay, so it can be called the balance sheet, it could be the statement of financial position. It reports assets, liabilities, and equities, and it reports those at a specified time. So when you look at the date of the balance sheet, it's going to be one single date, such as December 31st, 2020, or any year. So it's not as of December 31st. It's not as of, it's a specified date. It provides information about the resources. Well, what are the resources? The resources are the assets, obligations to creditors, and equity to equity and net resources. If you remember the accounting equation, assets equal liabilities plus equity, and you saw this so many times in my course. Assets are your resources, so it tells you what resources do you have, what obligations do you have, and what's the equity in the business. So what is the purpose? What's the one of the main purpose of the balance sheet? It's going to help us predict the amount, timing, and uncertainty of that magic word, future cash flow. So looking at the balance sheet, it's going to tell us, it's going to help us predict the amount, when are we going to receive the money, you know, what uncertainties do we have about our future cash flow. So this is the purpose of the balance sheet. So how does it help us? Well, we're going to be computing eventually rates of returns that deals with the balance sheet, and we're going to look at those later on. It's going to help us evaluate the capital structure. Now, when we say the capital structure, what do we mean by the capital structure? Well, assets equal to liabilities plus equity. Okay, liability and equity is our capital structure. Are we relying more on debt, or are we relying more on equity? Is it 50-50? Is it 40-60? 40-60? Is it 60-40? So this is going to help us the capital structure, and this deals with how are we financing the company. Are we relying more on debt, or are we relying more on equity? And by doing so, by looking at our capital structure, it's going to help us assess our risk and our future cash flow, because if a company relies, generally speaking, if they rely more on debt, generally speaking, they are a riskier company. Okay, but specifically, when we analyze the company using the balance sheet, we're going to look at three different categories: liquidity, solvency, and financial flexibility. And what does each one of those mean? When we talk about liquidity, it's generally related to the amount of time that's expected to pass until an asset is converted to a cash or a liability is paid. So basically, liquidity deals with short-term debt service. What do we mean by this? It means, are you able to finance your company or to stay afloat in the next 12 months or in a short period of time, okay, until the liabilities, at least the current liabilities, are paid. So are you going to be good in the short term? This is what liquidity is. Do you have enough liquid asset to meet your obligations. Solvency, similar, but solvency, think of it as it deals with long-term debt. And long-term debt deals with long-term, okay? Do you have the ability in the long term to pay your debt as they come mature? So it's going to help us look at this idea of the company. So we're going to be looking at ratios such as debt to equity, debt ratios, as well as long-term liquid solvency ratios, and we'll look at this later on. And it's going to tell us how flexible is the company is. Okay, what is the flexibility? For example, can the company take advantage of an opportunity if that opportunity arises? When can you take advantage of an opportunity? It's when you have excess cash. It's when you have excess cash, or if you don't have excess cash, you have low debt. When you have low debt and an opportunity came, guess what? Then you can respond quickly by going to the bank and taking out a loan because you are not under debt, financial trouble. Okay, so this is the usefulness of the balance sheet specifically. The usefulness of the balance sheet. So what are some of the limitations of the balance sheet? So the balance sheet is great, but what are some of the limitations? Well, for one thing, most assets and liabilities are reported at historical cost. And the key word is most, not all of them, because you're going to see later a lot of our assets are reported on something other than the historical cost, maybe the fair value, maybe the not realizable method, maybe the LCM, lower of cost or market, but a lot of it's still reported at historical cost. And historical cost tells us how much we paid for it, and it doesn't change the value, so it's not very useful. Okay, that's one limitation. The extensive use of judgment and estimate. A lot of items on the balance sheet we use estimates and judgments. Like when we do depreciation, well, guess what? Depending on the method that we're using, it's gonna give us the depreciation amount. Or when we estimate bad debt expense, or when we estimate our liabilities for warranties. So there's a lot of estimates that goes on the balance sheet. So, well, if there's estimate, there's a room for error, there's a room for mistakes, but we do what we can. But once you have an estimate, it may not be 100% accurate. This is the point. And many items of financial values are omitted. Like what? Like, for example, think about your workforce. Your workforce may be your greatest asset, or maybe your R&D personnel. Guess what? Those items don't appear on the balance sheet. Maybe your customer base. You have an excellent customer base. You have a loyal customer base. You have a good reputation. Okay? But those are very hard to quantify assets. So you really cannot put them on the balance sheet as those are my assets. Well, you can't. So there are some assets that are missing. Okay? So you can show some assets, but not all the company's assets. And this is where the role of analyst, the role of business experts that will go into the company, talk to management, and find out what they are doing and how well they are running the company. This is how the CEO of Berkshire Hathaway, Mr. Buffett, analyzes a company. He looks at soft assets, assets that don't appear on the balance sheet. Management, is the management competent? So those are assets that don't appear on the balance sheet. Identify the major classification of the balance sheet. So what are the major classification? We already talked about them: assets, liabilities, and equities. And hopefully you know what an asset is: probable future economic benefit obtained or controlled by a certain entity as a result of a past transaction. Liabilities are probable future sacrifices. So assets are benefit, liabilities are sacrifices of economic benefit, usually cash. You sacrifice cash arising from present obligation. You have an obligation to transfer an asset or provide a service. This is when you have an obligation. Either you have to give them cash or you have to provide a service in the future, and usually you do this in the future as a result of past transaction. So liability is something happened in the past, created a current obligation, so it has a past, current, and future aspect. So something happened in the past, you borrowed money, now you have a current obligation, you have to pay in the future. And the difference between assets and liabilities: assets minus liabilities equal to equity, and this is the residual interest in the asset of the entity that remains after deducting its liabilities. In business enterprise, the equity, whatever remained, should be the ownership interest. So whatever remained is supposedly, this is the value that goes to the shareholders. So if we only have one shareholder, it goes to the whole shareholder. Now, the relationship between assets, liabilities, and equities were covered in chapter 3. Okay, so if you're not sure, just go back, just keep going back in my lectures, or go to chapter 3 in my channel and take a look at how equity is created, so on and so forth. But now we're going to be looking at the classification of the balance sheet. And again, you're gonna feel as if I'm going through a list of items, and I will, because that's the only way I can go through this chapter. So we're gonna look at assets, we're gonna look at current assets, long-term assets, PP&E, intangible assets, and other assets. Generally speaking, this is how a company report their assets in these 5 categories. Some you could look at them as 2 categories also. And what I mean by 2 categories, either long-term, current, or non-current. So everything else is non-current, and you have your current assets. And current assets are what? We're going to look at each one of them separately. And liabilities, they have 2 categories, current and long-term. And equity, we have 3 main sections of equity. We have more, but I will see that. So in practice, you would usually see little departure of these major subdivision. Most companies, that's how they break down their balance sheets, current and non-current. Let's start with current assets, define what a current asset is, and after we define what a current asset is, look at what is included, what is included in that section. Okay, so current assets are what? Current assets are cash and other assets. Generally speaking, cash is a current asset that a company expects to convert into cash, sell, or consume either in 1 year or in the operating cycle, whichever is longer. We'll always assume that 1 year is longer than the operating cycle. We're using with a 1 year operating cycle. So what are we saying? Current assets are things that's going to be either converted to cash, sold, or consumed. They're going to be gone in 1 year. What are some examples of those assets? Okay, and those assets, if you really think about it, they deal with liquidity. They're going to tell us, do we have enough liquid assets? Liquid is how fast could you turn something into cash. Do we have enough to pay off our current liabilities? And on the balance sheet, they are listed in the order of liquidity. Cash is the most liquid. Short-term investments comes next. 1, 2, 3. Those 3 are considered the most liquid. Then 4 is your inventory. 5, prepaid. And if you have supplies will be there. So again, those are the assets that's going to help you pay your short-term obligation. Do you have enough of those? This is what the current assets are showing us. Do you have enough of those that you can survive in the near future? Okay, and how do we report them? How do we report them? So how do we report them on the balance sheet? Cash and cash equivalent is the fair value. If you have $100,000 in cash, it's $100,000 in cash. So if you have it in euros, you'll convert it into dollar, and that's the fair value. Short-term investments, generally speaking, you'd report them at fair value. And we have a whole chapter about investments, but generally speaking, if you have short-term investments, you report them at fair value. Receivable are reported as the estimated amount collectible. So they are reported at how much you will expect to get for them. This is called NRV, or net realizable value, NRV, or net realizable value. So you'll have an inventory, a receivable, then you will see how much of it you'll be expected to collect. And for each one of them, we're going to have a chapter. For example, for cash, just kind of walk you through this, because this is the for cash and receivable, we're going to have one chapter. We're going to have one chapter for inventory, one chapter for investment. So eventually we're going to cover each one of those in details. But receivable, that's how it's reported. Inventory is reported at something called LCM, lower of cost or market. So that's another method that we will use. And prepaid expenses are reported at cost. So notice what I said when we started this. I said most are reported at cost. So the only thing in these is reported at cost is the prepaid. And generally the prepaid is not really a large number in any company. So notice we are going further and further from the cost. Okay, we're using other bases to value the asset. And what is LCM, lower of cost or market? We'll see that later on. Just notes we use LCM, lower of cost or market. So what is the correct order to present the current assets? Well, cash is obviously the first. Then after cash, what comes next? Not inventory. Inventory does not come next because it's not as liquid. So account receivable, they're both right. Then between, now we have cash, account receivable, that sounds right. Then between prepaid and inventory, no, prepaid is not. Inventory is more liquid than prepaid, so the answer will be B. But between cash and account receivable, if we have investments, it's going to be investments, if we do have investments. So this is just an example of a multiple choice question. It's the in order of liquidity. Which one can we convert into cash the fastest? Okay, so let's look at cash and what is considered cash. Generally, any money available on demand is considered cash. Okay, now we always say cash and cash equivalents. What are cash equivalents? Cash equivalents are short-term, highly liquid investments that mature within 3 months or less. So it could be U.S. Treasury. Okay, for example, you lend the government money for 3 months or for 6 months, but now there's 3 months is less. 3 months is remained for this for the bond to mature. So any highly liquid investments that mature within 3 months. Again, we're talking about U.S. T-bills, Treasury bills. Okay, and restriction or commitment must be disclosed. So if you have any restriction or commitment on your cash account, you must disclose it. For example, here we're going to look at this company. We're going to look at some samples as we're working through this. So this way you'll have an idea what a balance sheet looks like and what type of description or notes do we need to attach to the numbers. So we have Altera Healthcare Corp. That's their cash position, 18 million and some change. Restricted cash and investments, they have 7.1 million, almost 7.2 million. So now when they have something restricted, they have to tell you why is it restricted. So look at note 7. Note 7, it says we have restricted cash and investments consist of CDs, certificate of deposit, as collateral for lease agreement and debt service with interest rate ranging from 4 to 5%. So what they're saying is this: they have cash of 18 million, 18.7, that's free and clear, and they have some restricted cash for 7.2 million, and they tell you why the cash is restricted. As an investor, as a creditor, you need to know why do they have restriction, and they're telling us here they have it in a form of a CD, collateral for a lease agreement, and debt service. So basically the bank tells them, for me to lend you money, you have to deposit some money and keep it on hold, and this is why, therefore, the cash is not free, it's restricted. So if they combine those two together, it will appear as if they have, that's 25, around 26 million, and they don't have 20, they do have 26 million, but 7.2 million of it they cannot really touch. Okay, so they have to tell you that's the case. This is another example of current assets for Owing Corporation. So they have, this is cash and this is restricted securities. Again, you would look at note 23, and sometimes you might have other restricted securities under other assets. And here, this is how you could read this just to see how sometimes they have restriction on certain investments. The insurance settlements fund are held and invested by the Fireboard Settlement Trust and are available to satisfy the pending and future asbestos related liabilities. Okay, these assets of the trust are comprised of cash and marketable securities and are reflected as Owens Corning consolidated balance sheet as restricted assets. Okay, so those are restricted securities, and they're telling you why they're restricted. It's to pay asbestos liabilities. Okay, so if there's any restriction, you have to tell us what's the restriction is all about. Short-term investments, again, we're not going to look at them in details a lot in this chapter, but believe me, there's one whole chapter devoted for this, and usually this chapter is intermediate too. Now if you really want to see this, I do have the chapter on my YouTube, but okay, so if you have investments, depending on how you classify your investments, you could classify it as trading, you can classify the investments as available for sale, or you could classify the investments as held to maturity. So If it's held to maturity, the only type of investments you could have is debt, because that the only thing that mature. You would report this as amortized cost. So as far as you're concerned for this chapter, you report it at cost. Okay, the classification could be current or non-current. So that could be a bond. So if you have money, you could invest some money in bonds, and that investments could be current or non-current. If it's going to mature within 12 months, then the bond is current. If it's going to mature in 5 years, it's non-current. Now you could also have investments in stocks and bonds. So you could have stocks and bonds, and you could classify them for trading. Trading means what? Trading means you're going to buy and sell them for profit purposes in the short term. You report those investments at fair value, and because you're planning to sell them in the short term, they are considered current assets. And this is the short-term investment section. Available for sale securities, you could have available for sale. Available for sale means not trading. You're not going to trade them, not for trading in the short term, and not HTM. HTM is held to maturity. So it's not this category, it's not this category. What's left is available for sale. Kind of a default. You could have both debt and equity, which is stocks and bonds. They are reported at fair value. They could be current or non-current. And what's the difference between trading and available for sale? They do sound the same. Between this and this, they do sound the same, but they're not. The way they are reported, the way we report the gains and losses is different between the two. We'll worry about this later on in another chapter. And this is an example of short-term investments for Intuit. So this is, if you look at their balance sheet, this is their cash and cash equivalent, and they have short-term investments. And definitely the company will need to show you what are their short-term investments. They don't have to give you a detail, but they have to give you some sort of a summary. So the following schedule summarizes the estimated fair value of our short-term investments. They are all available for sale. That's their category. And I used to do this for a company where I have to list prepare the schedule when I used to prepare their financial statements. They have corporate notes. So they lend some money to corporations. They have municipal bonds. They invested some money in municipal bonds, and they have government securities. And I'm assuming that these all add up. Yeah, this should be an 8. So this is all their investments, all their short-term investments. So they don't have stocks, for one thing. If you notice here, they don't have stocks. Mostly bonds and borrowing. They don't. It seems very conservative. This is Intuit. This is the company that creates TurboTax and QuickBooks. This is the company that pretty much drove H&R Block out of business. But yes, Intuit, they really do a good job. Okay. Receivables. So the company will have to show the receivable. Most categories of receivable should be shown on the balance sheet or the related notes. So a company should clearly identify anticipated losses due to uncollectibles. So if the company thinks they will not be collecting certain amount of receivables, they have to tell you how much is it. Okay, this is you remember this is called bad debt expense. This is as a result of the bad debt expense. They have to show you the allowance amount and nature of any non-trade receivable. Generally speaking, when you sell your product and you sell it on account, it's considered a trade receivable. So when we say receivable, what we mean is trade receivable. Okay, so if the company has non-trade receivable, so what could be some non-trade receivable? Well, it could be an income tax refund. So the company filed for a refund and they're waiting for their money. It's a receivable, but it's a non-trade. It has nothing to do with their operation. It could be a lawsuit. They won a lawsuit and they are waiting to be paid. It's a non-trade receivable. Also, they have to show you if there's any receivable that's being held as collateral. Because what companies can do, they can take the receivables and do what? Pledge it like any other asset for a loan. So if they have any of these receivables pledged as a loan, then they have to show you that is the case. And they have to disclose it in their financial statements. So this is the receivable for Stanley Black and Decker. So this is the receivable, and notice it says net. Net means what? Net of the allowance. Okay, this is how much they expect to receive in cash. Expect to receive in cash. Okay, maybe the gross is higher, but this is how much they expect to receive in cash. Okay, and here, notice here, if you look at the node B, they're showing you how much is trade, how much it's trade note, where they're lending money to operate the business. Other account receivable, other means other things that they're waiting. It's a substantial amount. This is the gross. The gross is 1,473,000. Notice the gross obviously is higher. This is the gross. Whoops. This is the gross amount. This is the gross amount minus the allowance for doubtful account, minus the allowance gives us the net, and this is the amount. The net is the amount that we show on the income statement. Just give me one moment, please. Okay. There we go. We're back in business now. Okay, so this is the amount that we show on the income statement. Okay, the net amount as far as receivable is concerned. Inventory, when we have the inventory, we have to tell you how are we reporting the inventory. For example, lower of cost or market, and most companies use this method. What is this? We're going to have a whole chapter about inventory. You would look at it later. Which cost flow assumption are they using? Are they using FIFO, LIFO, the weighted average, specific identification? Any method they are using, they have to disclose it. And what we have in front of us, a ABOT laboratories. So they have finished product, work in process, and material. And most manufacturing companies, they have 3 types of inventory. Manufacturing companies, they will have material, work in process, and finished goods. So this is their total inventory, and this is the note. And you always have to disclose your inventory method. Inventories are stated at lower of cost or market using the FIFO basis, first in, first out. Okay. Again, we would have a one full chapter about inventories. Prepaid expenses, generally speaking, they are not an important number. They're usually a small amount in relationship to other assets. And what's prepaid expenses? Prepaid expenses are payment of cash that's recorded as an asset because the service or the benefit will be received in the future. You paid your rent, you prepaid your rent, you prepaid your insurance, you prepaid your supplies, you prepaid your advertisement, or you prepaid your taxes. So every time you make a cash payment before you expense it, because remember, you have to make record the expenses in the appropriate period. So if you reported any expense before that expense is supposed to be incurred, you just have to keep it as a prepaid expense. Okay, and let's take a look maybe at a balance sheet that shows prepaid expense. And here's prepaid expenses and other current expenses. They blend them all together. And usually it's not much to it. It's not much to the prepaid expenses. And this is for Hasbro. And I believe they have a lot in relationship to their total asset. That's around more than 10%. More than 10%. Okay. A summary, basically cash and other assets, a company. So what's the summary? What's current assets? This is the definition of current asset, and this is the total current asset for a company, a picture of the whole thing. Now we're going to move from current assets obviously to non-current assets. And non-current assets, generally speaking, we have securities, which is a tangible fixed asset or PP&E, special funds, and non-consolidated subsidiaries or affiliate companies. So we're going to look at each one of them separately. Again, go through an overview. What would the balance sheet looks like? And eventually we're going to find out, how does it work. So securities. What are securities? Securities are investments, but those investments are long-term. Remember, we had short-term investments. Earlier we talked about short-term investments. Those are long-term investments, not short-terms. Bond, common stock, long-term notes. We're going to have tangible fixed asset. Under investments such as land held for speculation, we're going to have maybe a special fund, sinking fund, pension fund, plant expansion fund, or cash surrender value of life insurance. And we're going to have sometime non-consolidated subsidiaries or affiliate companies. Again, we're not going to go through, we're not going to go through each one of those in details, which is going to give you an idea what type of assets a company could list under long-term investments. Okay, so long-term investments will not include this category, because trading is in the short term. So it's either it will have investments available for sale or held to maturity, but it should not have trading securities, generally speaking, because the nature of trading securities is to trade it in the short term. So this is an example of a company with investments, an ABC company, investment in UC Inc., and they have a notes receivable, as well as they have land held for speculation, a sinking fund, a pension fund, and those are all investments. For marketable securities, management intent determines current or non-current. So if you have stocks and bonds, how do you know if the stock or a bond is a current or a non-current? It all depends on the company's intent. Are they planning to hold them in the short term? Are they planning to sell them in the short term? Are they planning to hold them forever? Or it's someplace in between? This is how we determine if it's trading, held to maturity, or available for sale. So what else we could have under long-term investments? So we're looking at stocks. We could also have land held for, and notice here, for speculation. Speculation means to make a profit. Why do we need to differentiate this? Because if you bought a piece of land, you know, the first thing you think about, well, it's a land, it's a property, plant, and equipment. True, but sometimes the companies buy a piece of land as what? As a speculation. Speculation means what? Speculation means they want maybe to sell it if the prices go up. So that's not really an investment for property, plant, and equipment, because when we say property, plant, and equipment, what we mean is it's going to be used in operation. So this land, it's not going to be used in operation. Okay, so this is why we say it's held for speculation. If it's held for speculation, it's listed under investments. Now we could also have what's called a sinking fund, the pension fund, cash surrender value. Basically, a sinking fund is when you put money away. You put money away for a purpose, and that purpose could be to retire a bond or for future plan, but usually you invest this money and it's invested in the long term and you cannot touch it. It's a sinking fund. A pension fund is when you promise your employee pension payments after they retire. So, well, before they retire, you have to create a fund and do what? And finance this fund, put money into that fund and invest that money for your employees when they retire. So this is called a pension fund. So you'll have different assets in that pension fund. Also, you could have cash surrender value. In life insurance, you could have investments in life insurance for employees and the company. What else do we have? And we could also have under this categories investments in consolidated subsidiaries. So those are investments in other companies, but we don't consolidate those companies. So we have investments in other companies, but we don't combine both companies together. Therefore, we're showing the investment separately, because if we combine them together, then we will not show the investment here. It will be combined with the main balance sheet. So this is the Motorola long-term investment section. So notice they have equity investments, which is stocks. They have other investments, and they have fair value adjustments to available for sale securities. You don't have to worry about this fair value adjustment, at least now, but later we're going to have chapter 17 will cover this topic. So chapter 17, we're going to talk about, you know, investments, how to account for investments. Okay. So the next thing on the balance sheet comes property, plant, and equipment. And obviously, what goes under property, plant, and equipment? Property, plant, and equipment are tangible, long-lived assets. So notice they are tangible. Tangible means you can touch them, because we're going to have assets that we cannot touch. Okay? Tangible, long-lived assets used in regular operation or in operating the business. Okay? So what could be examples of property, plant, and equipment? Those could be land, but remember, not land held for speculation, building, machinery, furniture, tool, and waste and resources such as minerals. So those are the assets that we consider them property, plant, and equipment. And sometimes you know them as P&E. Sometimes they are called fixed asset. I'm not sure if they're called something else, but those are the two names that I can think of, PP&E and fixed asset. Maybe they're called something else. with the exception of land, a company must either depreciate or deplete, if it's a natural resources, these assets. So we have to eventually expense them. Depreciate them and deplete them means expense them. And depreciation expense means allocate the cost to period benefited. Okay, so this is what we mean by depreciation. So we have to eventually expense them. Okay, now why don't we depreciate land? Let's just talk about this, because to depreciate something you have to assign a life, a number of years, and land is considered to have indefinite life or unlimited life. That's why when we have an unlimited life, when we determine and an asset has an unlimited life, then you cannot depreciate. You cannot allocate the cost over the period benefit, because remember, depreciation is taking the cost and allocate it over period benefit. Well, the period is unlimited, so how can you allocate the cost over an unlimited period of time? So that's why land has unlimited life, therefore it's not depreciable. And this is an example of a balance sheet with property, plant and equipment, building, land, machinery, capital leases, leasehold improvement, accumulated depreciation. This is the contra asset account. And basically what the company will have to do, they'll have to disclose the basis it value property, plant and equipment. And if we're using US GAAP, let me tell you what the basis are. The basis is the cost basis. It's very simple. When we buy property, plant and equipment, we keep it at cost. And we have to disclose, for example, we may have a schedule of, of the buildings, of the major buildings that we have. Okay, maybe we need to talk about a little bit about the machinery and equipment. How do we depreciate the machinery and the equipment? How do we classify each assets in what group, so on and so forth? How do we come up with this? If there is a lien against that machinery or that land or that building, we need to disclose this. So we would need additional disclosure, at least which depreciation method we are using too, because we are depreciating those assets. So we need to tell the users, are we using the straight line, accumulated accelerated depreciation, makers, or whatever method we are using. Not makers for tax purposes. Okay. Also, well, this is the property, plant and equipment for Mattel. Mattel is the company that manufacture Barbie dolls, so they have land, building, machinery and equipment, leases, leasehold improvements, total assets, less accumulated depreciation. Then they have tools, dies and molds, net amount, then net property, plant and equipment. Okay, so this is an example of a company, property, plant and equipment. Once again, they'll have to do additional disclosure about those property, plant and equipment. Okay, intangible assets, we're going to have a whole chapter about actually property, plant and equipment and intangible asset. I know we're going through this, it seems as I'm going through the index of the textbook, because every topic you're covering now we're going to cover in details in another chapter. One whole chapter for property, plant and equipment, one whole chapter about intangibles, one whole chapter about investments, one whole chapter about inventory. I know we're going through them now, but eventually we're going to learn the details of each one of them. So what are intangible assets? Intangible assets are assets that lack physical substance and are not financial instruments. In other words, they are not stocks or bonds, and they lack physical existence. Okay, what are some examples of intangible asset? Goodwill, which we'll talk about later, patent, trademark, franchise, and copyright. And if you watch Loan Sharks, and hopefully you do, they always ask them if they have an idea, that they patent this idea, because when you patent an idea, that's considered an asset. Okay, now we're going to learn later, how do you put the patent on the books, how much you can and cannot, if you bought it or if you created yourself. But a patent is an idea, then it's an asset. Trademark, for example, if you see the Apple phone, it has the Apple, that's the trademark for the iPhone. It's worth a lot. Why? Because trademark have a market value. So if someone sees the Apple sign, they trust the product because the product is reputable. So that's why it's important. The franchise, for example, if you operate a McDonald's or a Subway, once someone sees the signs, they most probably will stop by, they'll trust the name. Copyrights for books and songs, so you will protect the author's copyrights. We're gonna see later that certain intangibles have limited life and others will have unlimited life. And when you have unlimited life for an asset, you will test it for impairment. For example, goodwill has an unlimited life, okay? And limited life you amortize. Amortize is the same thing as depreciation, but it's for intangible assets. You don't depreciate intangible assets, you amortized intangible assets. And let's take a look at this example. We have Patrick Corporation. Adjusted trial balance contained the following assets: prepaid rent, goodwill, franchise fees receivable, franchises, patent, trademark. Prepare the intangible section. So which one of those are intangible and which one of those are not intangible? Okay, so let's take a look at this. All right. Prepaid rent. Prepaid rent is not intangible. Remember, prepaid rent is a current asset. Goodwill is an intangible asset. Now, what is goodwill? Because again, I said I'm not going to cover goodwill, but goodwill is when one company buys another company. And let's assume one company. Let me just explain this real quick. Company A buys Company B. And when Company A buys Company B, they would look at Company B. Let's do it on the, let's do it real quick here. So what they do is they look at Company B, and they would say Company B, they have assets of $450,000, and this is the fair market value. In other words, this is how much those assets are worth today at fair market value on the market. And they would look at their liabilities. So because when you buy a company, you buy both their assets and their liabilities, and the fair market value of their liabilities, let's make it $100,000. So the equity or this business is worth on fair market value $350,000 fair market value. So this is how much this business is worth, $350,000. Here comes Company A, and Company A actually pays to buy it. They pay, let's assume they pay $500,000. So they pay $500,000 for something that's worth $350,000. So when they journalize the entry, they will debit the assets that they purchased. They bought assets $450,000 worth. They will credit their liabilities because they did add $100,000 of liabilities when they bought this company. They will credit cash because they paid cash $500,000. Now what's left? What's left is $150,000 because this entry, those two, and this is $600,000 and this is only $450,000. The difference between the two is called goodwill. Now what is goodwill? Goodwill is the excess amount that we paid over the fair market value that we cannot assign to any asset that we purchased. So in other words, we paid $500,000. $500,000 is $150,000 more than what the company is worth. Now, why did we pay this? The question is, why did we pay this? Well, we really don't know why, or we cannot attach this additional value to an asset. It could be because of the location of the company. It could be because of this company's connection to the government. It could be because of their customer base. But certain things that we cannot assign, specifically assign. So therefore we call it goodwill. So it's that everything else that that we cannot explain. Okay, that we paid extra, we cannot explain, we cannot put on the financial statements. So goodwill indeed is an intangible asset. So goodwill is an intangible asset. Franchise fees receivable. Don't be misled. This is receivable. This is an asset. We are waiting for $2,000. Nope. Franchises, yes. franchise is an intangible because you paid a fee. Patent is an intangible. Basically, a patent is it's extremely important, especially for pharmaceutical companies. That's an intangible. Trademark are also intangibles. So those the four are intangibles, which are goodwill, franchise, patent, and trademark. Total of 140,000. This is the intangible. Again, we'll see this in chapter 11 in details later on. Intangible asset. This is for PepsiCo. So they have goodwill, a lot of goodwill. They buy other companies. That's why they create goodwill. They have trademark, and they have other identifiable intangibles. So I don't want you to think that this trademark is the PepsiCo trademark, because when you create your own trademark, you don't put it on the books. We'll talk about that later on. But this is a sample of intangible assets. Okay. The companies could also have other assets. Okay, they may include long-term prepaid expenses, non-current receivable, assets and special funds, deferred income taxes, which we'll see that later on in chapter 19. This is the dreaded chapter 19. No one likes this chapter. Property held for sale, restricted cash or other securities. So those are, if it doesn't fit anywhere, you could put them here if you would like to. But remember, property held for sale, it could also be long-term investments. But this is the category. In other words, the company will always have this option. So if they don't know where to put an asset, it's like it's not long-term, it's not current, it's not PP&E, it's not property, plant, and equipment, it's not intangible. Well, if it's not none of those, guess what? You could put it under other assets. So you'll always have this category. Okay, for example, if you have long-term prepaid expenses, well, it's not current, but it doesn't fit any other category, so you put it here. Okay, so this is an example of other assets for this company. They have prepaid pension cost, and they have deferred income tax. Okay, that's what they have. Again, this is the assets that don't fit anywhere, so we have create a category. The next thing we look at is liabilities, and liabilities are a little bit straightforward because they only consist of two categories, either current liabilities or non-current liabilities. So it's either classified as current or non-current. And how do we determine if a liability is a current or a non-current? Well, a current liability is a liability that reasonably expect to liquidate either through the use of current assets or the creation of current liability within 1 year, assuming 1 year is longer than the operating cycle. So any liability that we expect to pay off within the next 12 months is considered a current liability. So that's the liability that would expect us to liquidate either a current asset, which is cash, or the creation of a current liability, basically refinance it. Ask the creditor to give us more time. Examples are notes payable, short-term note, accounts payable, which is accounts payable is when you buy on account. Okay, when you buy on account. Accrued compensation, this is the amount that you owe for your employees. Unearned revenue, somebody paid you up front, you haven't performed the work. Income taxes payable, taxes that you owe, and current maturities of long-term debt. We'll talk about this maybe in a moment later on, current maturities of long-term debt. Now, this is an example for Halliburton company. This is their current liabilities. Notice short-term notes, and most companies, they will have those two for sure. They'll have some sort of a short-term loan and accounts payable. And also they would have accrued employee compensation and benefit, because if they have employees, they're gonna accrue some wages. Unearned revenue, maybe somebody paid them up front. Income taxes payable, accrued special charges. So those are some typical, and here they have a large other current liabilities, which is, they'll have to explain this in the notes. We don't know what this is. But those are the typical current liabilities that you will see for a company. The next thing we look at is long-term liabilities. Long-term liabilities. Long-term liabilities are obligations that do not reasonably expect to be liquidated within the operating cycle, which is we assume to be 1 year. So those liabilities that will stay with us, longer than 1 year, okay? Like what? Like long-term debt, obligation capital lease of a capital lease, and deferred income taxes. Those are liabilities that will stay with us longer than one period, or those liabilities we would require to reissue long-term debt to refinance them. Okay, you could read this article. It's about before the dot-com bubble. Concerns about liquidity and solvency led creditors of many dot-com companies to demand more assurance that these companies could pay their bills when due. A key indicator for creditors is the sum of the vendors demanded that their dot-com customers sign notes stating that the goods shipped to them would serve as the collateral for the transactions. Okay, so really, if you really think about it, your suppliers, the company that supply goods and services, they're the best people that knows how to evaluate a company. Because think about it, when a company runs into trouble, the first thing they do, they will start to ask their suppliers to give them more time, or to give them more time to pay, or they will even stop paying altogether. So your suppliers knows a lot about the company, and that's why a company like Apple, when they deal with a supplier, they make sure they have a secretive agreement between them and the supplier, and the supplier cannot breathe a word about how much they are supplying Apple. It has to be a secret. Another recent bubble in the real estate market created a working capital and liquidity crisis for no less than a company that's called Bear Stearns, which is gone now. Bear Stearns were one of the biggest investors in mortgage-backed securities, but when the housing market cooled off, the value of the collateral basically went down. Okay. For example, when a report predicted that Amazon working capital turned negative, the company's vendor began to explore steps that would ensure Amazon would pay them. Securities dropped dramatically, which is their stock, and the market began to question Bear Stearns' ability to pay its obligation. Well, again, short-term liabilities are extremely important for any company, because if you cannot meet your obligation, it's a problem. It's really a problem. Let's take a look at this example. Included in Adams Company, December 31st, 2014, trial balance are showing the following accounts payable, pension asset liability, pension asset / liability, discount on notes payable, unearned revenue, bonds payable, salaries and wages payable, interest payable. So they're asking us to prepare the long-term liability section. So which assets are considered long-term? Well, I'm going to tell you right now, accounts payable is not. So this is not. And then we cross accounts payable, the easy one that we can easily cross. Accounts payable is not. Pension asset liability, yes. Pension, generally speaking, when a company has a pension liability, it's definitely not in the short term, because this is planning for the future. So this is planning for the future. Discount on bonds payable. Generally speaking, bonds payable are long-term debt, and the discount on them is a contra liability, which is also long-term debt. Unearned revenue, generally speaking, no one pays you and they expect you to perform longer than a year. Bonds payable is a long-term debt. Salaries and wages payable, that's a no-no. That's a current liability, because no one will wait for you 1 year to pay them. Interest payable, generally speaking, banks, they want their money, and the government don't wait longer than a year. So the three long-term liabilities are pension liability, bonds, and discount. And discount is a contra liability, it reduces this amount. And the other ones that I crossed out, you might be asked what are the current liabilities, and those will be the current liabilities. All right, let's take a look at this example. And this is an example for the Great Atlantic and Pacific Tea Company. Their current liabilities, then their long-term liabilities, and there's a C note. And here what they do is they break down their long-term liabilities. They have debt consist of 9.5 senior notes, so this they pay 9.5% on this note. They have a mortgage and other notes that they pay 9.9. They borrowed from the bank this much at 9.7, and commercial papers at 9.4. And I remember when I used to prepare, I remember certain things really well. For when you have debt, you have to list all the classification of your debt. So that's one of the things that you have to disclose. Show me the breakdown of your debt, and what is your average interest rate. Now, they can either put it there, or someone can easily calculate the average interest rate that this company pays. Now, this is your total long-term debt. Then what you do after you calculate your total long-term debt, you deduct the current portion. This is the current portion of the long-term debt. So the total debt that this company owes is $314,931,000. This is the total debt, total long-term debt. Of this amount, $60,619,000, this amount here, which is I'm going to highlight in blue, highlight in a different color. This amount here is due the next 12 months. So the total debt that's going to be with them later on after they make the payments next year is $254,312,000. Okay, and I used to do this a lot when I was in practice. Well, I still practice a little bit, but I no longer have clients that have a lot of debt. But for companies, they might have 6-7 different debts, maybe sometime more. But this is what you have to do. You have to break it down, and you have to show if there's any collateral against that debt. Okay. The last section of the balance sheet is the owner's equity section. We're not going to really get into this because we're gonna look at this later on in details when we get to chapter 16. But let's cover what we need to cover. When the company issues stocks, they have to show if the company has a par value. So the par value, or the stated value of the shares issued. So if there's a par value, let's see if there's an example. Oh, there's an example for Las Vegas Sands Corporation. For example, the par value is 0.001. So what does that mean? It doesn't really mean anything. But if there's a par value, they have to disclose the par value. They also have to disclose how many shares are authorized. So they are authorized to issue 50 million shares. Of those 50 million, 3.6 million are issued and outstanding. It means they are sold. Actually, this is the preferred stock. The common stock, the par value is 0.001, the same as the preferred. They have 1 billion shares authorized. 707 million of them, I'm rounding, 707 million are issued. Okay, and this is the dollar amount. This is the dollar amount. So those are the common stock. Additional paid-in capital is what the investors put into the company. So those accounts here, preferred stock, common stock, and paid-in capital, those are called capital contribution. And capital contribution is what the investors invested in the company. Okay, so those three accounts shows that. Then, so this is capital stock. We looked at, the par value, then additional paid-in capital. Those are the capital contribution. So those two are considered represent capital contribution. Then what happened is the company will have another major category, which is called retained earnings. Oops, sorry. Okay. And retained earning is the corporation. Let's do a different color. Retained earnings is the corporation undistributed earnings since the company started. So when the company makes a profit, they can either distribute it or keep it. The amount that they keep from the earning is called retained earnings. So this is usually another main component of the balance sheet, the equity section. This is the first main section, which is contributed capital. I just highlighted in red. This is what the investors put into the company. Then retained earning is another major component of the equity section. Now you're saying, so what's that in between? What's that in between? That's called accumulated other comprehensive income. We'll talk about that later on. It has to do with comprehensive income. It has to do with certain items that bypass the income statement for now. We'll look at those later on. Just know that there's something called other comprehensive income. Generally speaking, is not a large component. Okay, and sometimes the company might have non-controlling interest. Non-controlling interest is the portion of the equity of the subsidiary not wholly owned by the reporting company. So basically what happened, at some point, what company is this? Las Vegas Sands. Maybe they bought another casino, and they purchased 95% of that casino, some other casino. So there's 5% that they not own. So 5% of the company they don't own. So they have to show the non-controlling interest, the interest that they don't own, which is represent that much. Why is it an equity? You don't have to worry about this. Just know the non-controlling interest. You know what it is. It's the portion of the equity of the subsidiaries not wholly owned by the reporting company. Just know what it is. Eventually you will take advanced accounting and you will know exactly how to calculate this component. Okay. And let's take a look at this example. And basically what we need to find out is a classification on the balance sheet. Where do these items goes on the balance sheet? Well, let's start with the first one. If you have an investments in a preferred stock, so you bought stocks, well, think about it. Investments, well, we need more information, because remember, an investments could be short-term, and investments could be short-term or long-term investments. So for this, it could be current or long-term investments. Treasury stock, which we did not talk about, it should have been listed here under equity. Treasury stock is an equity, and treasury stock, to be more specific, it's a contra equity. Contra equity. What is treasury stock? Is when the company buys back its own stock. When it buys back its own stock. Common stock, we already know it's part of stockholders' equity. Cash dividend payable, the word payable tells you what? It's a liability. And what type of a liability? When the company promised to pay dividend, they don't wait a year, longer than a year to pay it. Usually they pay it fairly quickly, so it's a current liability. Accumulated depreciation, this is a contra asset, and it goes under the property, plant, and equipment, PP&E. It's a long-term property, plant, and equipment. Interest payable, we know from payable it's a liability, and when you owe someone interest, they want it fairly quickly. A deficit, and this is what they mean, deficit in retained earnings. And remember, retained earnings is that amount that we keep the profit, but sometimes what happens, we distribute all the profit and more than the profit that we incurred over the years. And what happened when we do this, or we keep on incurring losses and the retained earning goes to zero, then it goes -0. Once the retained earnings goes below 0, we call it deficit. Now, trading securities, this is easy. Trading securities is a current asset. And unearned revenue, remember, unearned revenue is the money that they paid us before we perform the service. When someone pays you this money, they don't wait longer than a year for you to perform. So it's a current liability. Let's see what we have. Prepare the classified balance sheet using the report and the account format. So when we prepare a balance sheet, we could use the account form or the report form. Okay. So the AICP indicate that all of the 500 survey companies either use the report form or the account form, sometimes collectively referred as the customary form. Okay, that's fine. This is the report form. The presentation of the balance sheet meets the objective of the financial reporting to provide information about the entities, claims, and resources. Obviously, this is what we were talking about. This is the report format.
At the end of this recording, I'm going to invite you again to visit my website, farhatlectures.com. Please like this recording, share it, and if you have a CPA prep course, that's fine. You can keep your CPA prep course, but you might need additional explanation. I do provide you with additional explanation. Your CPA exam is 20 to 40-year investment. Don't shortchange yourself. My subscription is nominal based on the value and based on the long-term investment that you're going to be making in yourself by passing the exam. So go ahead, pass the exam, put it behind you, study hard, and most importantly, stay safe.